morning. So have you gone through the report? What are the key salient points you think that stand out? How do you think in general the FI community is likely to react to this?
I've looked at the press release. I don't think the full report is out available yet. But just looking at the press report that has been released, it's quite concerning because it's one step forward, two step backwards for us as far as the FPIs are concerned. There are a few things that SIT has stated which are very concerning. Firstly, their statement that this is ultimate beneficial ownership information is not available with SEBI, and the fact that most of these investments are coming through, for example, Cayman is 31%. They've specifically highlighted that and said, the population is some 50,000 people in Cayman, and yet the investment is some 85,000 crores. How does that tie up? It just shows that there is a lack of understanding of how international markets work and why significantly U.S. tax-exempt investors invest via entity jurisdiction like Cayman, which is used as a place for pooling of funds. So overall, it seems like a lack of understanding of how the international markets work. As far as the report is concerned, if you go back to the history of how the FI regulations have developed since 2007 till today, there's been a significant dialogue with SEBI over ultimate beneficial ownership, KYC requirements, how to do the reporting, and ultimate responsibility of the FPIs who are doing the ODIs, who are issuing the ODIs to these investors. And there is a lot of history here which has maybe SIT is not aware of.
Okay, Pratibha, one of the recommendation is basically tighter KYC norms. How applicable or easily applicable is it if in case it's taken forward?
Oh, it's extremely difficult, onerous, and what it'll do is it'll make it difficult for the big institutional investors like the US pension funds, the global insurance companies to invest into India. See, today the way the markets work is that you have the FPI that is registered with SEBI, and for the purposes of being able to do the ODI, the fund has to be regulated in the relevant jurisdiction. So you're not talking about unregulated activities here at all. The fund that is issuing the ODI has to be regulated. And the fund then ultimately has to be broad-based for it to be able to provide issue ODIs through the fund itself. So you have various safeguards that are available. You've got to be broad-based, so it's not like you have NRI money coming straight, because NRI is straight, and SIT has actually mentioned that NRIs and resident Indians can't straight take ODI issuances.
Sure.
So you have the broad-based requirement, you have the fund itself, which are regulated entities required to do KYC on the ultimate investors. Now, if you get that KYC requirement that the fund itself does, the manager will do, to be done, and provided to SEBI, these are broad-based funds. They could be, 40, 50 investors, 200 investors at the back of it. Till what level will you go to get to the individual? It's completely impractical.
Sure. So Pratibha, what's your sense? What do you think is the future for P-notes? Do you think we are going to now increasingly see P-notes not being used and ultimately go out of the fashion? I mean, how do you think this whole situation will evolve?
See, the ultimate aim of the regulator is to try and get as much direct investment and not use for investors not to use the ODI route. It's laudable aim, but we have to understand that until and unless we provide to investors the comfort of ease of doing business in India, easy investment and easy out, because this is listed securities, these are liquid investments where they have to have that comfort that India is a jurisdiction where you can easily come in and go out. That comfort is not there today. That's why you have investment managers who provide that comfort through the ODI, saying, you know, you take the ODI, I will ensure that liquidity to you, and I will take the risk of the onshore regulations. So till, you know, that whole noise around, you know, the investments and over-regulation in India goes away, the purpose we are trying to achieve is not going to get achieved. So this is actually going to harm us in the long run.
Okay. Quick 2 questions then, Pratibha. First, tell us, what is the way forward then? What do you think should happen? Should there be a Ministry of Finance intervening in this? And secondly, we have the AP Shah panel which submitted their report to the Finance Minister as well. Your thoughts on the MAT issue?
Okay, so firstly on the SIT recommendation, I think it's very important that, you know, SEBI and Ministry of Finance proactively have a discussion with the industry, not let this linger, and then give those explanations back to SIT on how the international markets work and why what they have asked or provided as recommendations are not practical. On MAT, we are all eagerly awaiting again, you know, what Justice Shah Committee has finally recommended is not made public, but, you know, the market is expecting him to, the committee to come to the conclusion. If you look at purely from a legal perspective today, as per the Income Tax Act, that MAT is not applicable to foreign investors. The Castleton case and a few other cases, you know, one which we are representing, Aberdeen, is pending before the courts. And, you know, everybody is waiting for the committee report and, you know, what the prosecution then submits to the court with respect to that report. So it's very important.
Sure.
The report is extremely important, and we are hoping it will be positive for the markets.
All right, Pratibha. Thanks a lot for your time today.